Welcome to Unit 14, Chapter 3.2 on Financial Forecasting and Business Growth in Agribusiness. I'm excited to guide you through this comprehensive exploration of how agricultural enterprises can navigate the complex financial landscape to achieve sustainable growth. Today's session will transform how you think about financial planning in agriculture. Unlike traditional businesses that operate in relatively predictable environments, agribusiness faces unique challenges that require specialized financial approaches. We're dealing with biological cycles that can't be accelerated, climate dependencies that are increasingly unpredictable, and market volatility that can shift dramatically within a single growing season. This isn't just another finance course adapted for agriculture. It's a specialized framework developed specifically for the realities of modern farming operations. By the end of our time together, you'll have practical tools and strategies that you can immediately implement in your agricultural enterprise, whether you're managing a family farm or planning the next phase of a larger operation. Let me set the context for why financial forecasting has become critical in modern agriculture. We're operating in an era of unprecedented change that's fundamentally different from the agricultural environment our predecessors knew. Agricultural enterprises today face a perfect storm of challenges. Climate disruption is no longer a future concern, it's happening now. Growing seasons are shifting, precipitation patterns are becoming unpredictable, and extreme weather events are increasing in both frequency and intensity. Just last year, European farms experienced everything from severe drought to devastating floods, sometimes within the same growing season. Global competition has intensified dramatically. Local producers now compete not just with neighboring farms, but with agricultural operations from around the world. Technological transformation is both an opportunity and a challenge. Precision agriculture, robotics, and artificial intelligence promise significant efficiency gains, but they require substantial upfront investments and new skill sets. The farmers who thrive will be those who can strategically finance and implement these technologies. Consumer demands are evolving rapidly towards sustainability, traceability, and quality. This creates opportunities for premium pricing, but also requires additional investments in certification, practices, and marketing. This isn't just about basic budgeting anymore. We're talking about strategic financial planning that enables resilience and adaptation. The goal is to transform financial planning from a necessary administrative burden into a powerful strategic tool that supports your long term vision and drives sustainable prosperity. Let's dive deeper into what makes agribusiness financial planning fundamentally unique and why traditional business approaches often fall short in agricultural contexts. First, the importance lies in operating within complex ecosystems shaped by biological cycles and market volatility. Your production timeline is dictated by nature, not market demand. You can't speed up crop growth or delay harvest to match optimal market conditions. This biological constraint requires financial planning that accommodates fixed production cycles while maintaining flexibility in marketing and resource allocation. Second, unlike conventional sectors, agribusiness must tailor approaches to biological cycles, climate dependencies, and regulatory frameworks. Consider the complexity. You're managing assets that grow and reproduce, dealing with living systems that can get sick or die, and operating under environmental regulations that are constantly evolving. Your working capital needs spike during planting and harvesting, creating cash flow patterns that would challenge any traditional business model. Third, robust forecasting enables not just survival, but thriving through adaptation. The most successful agricultural operations I've studied don't just weather challenges, they anticipate them and position themselves to capitalize on opportunities that others miss. They use sophisticated forecasting to identify optimal planting schedules, predict input needs, and time market entries. Finally, strategic planning addresses unique challenges while leveraging specialized forecasting methods. This includes yield based revenue projections that account for weather variability, price trend analysis that considers seasonal patterns and storage costs, and diversification strategies that spread risk across multiple enterprises and revenue streams. To illustrate this complexity, consider a European grain farmer who successfully navigated the 2021 to 2022 commodity price volatility. While many operations struggled with input cost inflation and supply chain disruptions, this farmer had developed scenario based financial models that anticipated these challenges. They had pre negotiated supply contracts, established alternative input sources, and maintained strategic cash reserves. When fertilizer prices spiked 149%, they were prepared. When commodity prices reached historic highs, they had marketing plans ready to capture optimal pricing. Let's talk about the challenges facing modern agribusiness because they are not isolated problems. They're interconnected forces that compound each other's effects, creating a complexity that requires sophisticated financial management. Climate change represents perhaps the most fundamental disruption to traditional agricultural planning. We're not just talking about gradual warming, we're seeing dramatic shifts in precipitation patterns, temperature extremes, and growing season timing. In Europe, harvest dates have shifted by an average of 10 to 14 days earlier over the past 2 decades. Spring frost events are becoming more unpredictable, threatening fruit crops that have already begun flowering. This creates planning nightmares. How do you budget for irrigation when you can't predict precipitation? How do you plan labor schedules when harvest timing becomes unpredictable? How do you manage storage and marketing when weather affects not just your production, but that of your competitors worldwide? Global competition pressures have intensified beyond anything we've seen before. A grain farmer in France now competes directly with operations in Argentina, Ukraine, Charlie, and or Corn. Each of these regions has different cost structures, labor availability, and government support systems. Some have access to cheaper land, others to lower cost labor, and many benefit from currency fluctuations that can dramatically affect competitiveness. This competition forces constant innovation and efficiency improvements. You can't just maintain status quo and expect to remain profitable. You need financial strategies that support continuous improvement while managing the risks associated with change. Commodity price volatility adds another layer of complexity that can make or break operations. Prices can fluctuate 20 to 30% within a single growing season. Input costs show similar volatility. This volatility makes financial planning incredibly challenging. You're making planting decisions based on price projections that may be completely wrong by harvest time. You're committing to input purchases months before you know what your revenue will be. Consumer demand for sustainability is reshaping market requirements in ways that create both opportunities and obligations. Consumers increasingly want to know not just what they're buying, but how it was produced. This creates opportunities for premium pricing through organic certification, sustainability labels, and direct marketing. However, it also requires additional investments in certification programs, documentation systems, and marketing infrastructure. The shift towards sustainability often requires upfront investments with uncertain payback periods. Finally, technological advancements promise significant long term efficiency gains, but demand substantial capital investments during a period when many operations are already financially stressed. Precision agriculture technologies can reduce input costs by 10 to 15% and increase yields by 5 to 10%, but they require initial investments of 50,000 to 200,000 euros for most operations. The challenge is financing these investments while maintaining operational cash flow and managing the learning curve associated with new technologies. Why we need now financial forecasting more than never. Financial forecasting serves as the foundation for all strategic decision making in agribusiness, but it functions differently than in other sectors due to the unique characteristics of agricultural production. Sophisticated forecasting models in agribusiness must incorporate seasonal cash flow patterns aligned with harvest timing and production cycles. Unlike manufacturing or service businesses that can generate relatively consistent monthly revenue, agricultural operations often see 60 to 80% of their annual revenue concentrated in just a few months. Your financial model must account for this reality while ensuring adequate cash flow throughout the entire production cycle. These models also account for the cyclical nature of agricultural production. Crop rotations, livestock breeding cycles, and equipment replacement schedules all operate on different timelines that must be synchronized in your financial planning. Strategic expansion decisions represent perhaps the most critical application of financial forecasting. Whether you're considering land acquisition, technology investment, or vertical integration, these decisions will impact your operation for decades. Your forecasting model must evaluate not just the immediate financial impact, but the long term implications for cash flow, debt capacity, and operational flexibility. Land acquisition decisions require forecasting models that account for appreciation potential, productivity improvements, and changing regulatory requirements. On the other hand, technology investments must be evaluated against productivity gains, labor savings, and competitive positioning. Financial forecasts enable vertical integration and diversification into complementary value chains. This represents one of the most powerful strategies for risk management and revenue enhancement. Diversification modeling helps you understand how different enterprises interact financially. Some operations complement each other: crop residues feeding livestock, livestock manure fertilizing crops. Others provide counter seasonal cash flows: summer crop production balanced with winter livestock sales or year round direct marketing. Finally, accurate forecasting supports informed growth planning by ensuring resources are allocated effectively for sustainable development. Growth for its own sake often leads to financial problems. Sustainable growth requires understanding your capacity constraints, market opportunities, and financial limitations. Effective forecasting helps you identify the optimal pace and direction of growth that maximizes long term success while minimizing risk. To be able to forecast your income and cash flows, you need to understand how to use different sources of capital. During this module, you will have the opportunity to find out about the diversity of sources of capital and how to take advantage of them for your agribusiness. Here we only make a short presentation of them, and in another lessons you will learn more. Agricultural ventures have access to a diverse range of funding sources, each with unique characteristics, requirements, and strategic implications. Understanding these options and how to combine them effectively is crucial for sustainable growth. Personal and family funding traditionally provides the foundation for agricultural operations. This includes personal savings, family contributions, and informal lending arrangements within farming families. These sources offer several advantages: no formal application process, flexible repayment terms, and no external oversight of business decisions. However, they also present limitations. Personal resources may be insufficient for significant expansion, family relationships can be strained by business pressures, and there's often limited expertise in evaluating investment opportunities objectively. Agricultural banking products represent the backbone of commercial agricultural financing. These specialized institutions understand agricultural cash flows, seasonal patterns, and asset characteristics in ways that traditional banks often don't. They offer operating lines of credit that accommodate seasonal cash flow gaps, equipment financing that matches loan terms to asset useful life, and real estate loans with extended amortization periods. Agricultural banks also provide specialized products like crop marketing loans that allow you to store commodities and market them strategically, livestock financing that accounts for breeding cycles and market timing, and disaster recovery loans that provide emergency capital when weather or disease creates unexpected losses. Cooperative financing structures enable shared resources and collective risk management within the agricultural community. Agricultural cooperatives often provide input financing, equipment sharing arrangements, and collective marketing services that improve individual farm economics. Credit cooperatives, particularly strong in countries like Germany and France, offer member-owned financial services designed specifically for agricultural needs. These structures provide several advantages. lower interest rates due to member ownership, understanding of local agricultural conditions, and flexible terms that accommodate seasonal patterns. They also enable economies of scale in purchasing, marketing, and risk management that individual operations couldn't achieve independently. Another two sources deserve your attention. European Union funding mechanisms provide substantial opportunities for rural development and agricultural modernization. The Common Agricultural Policy allocates €387 billion over 7 years, with significant portions available for investment support, modernization grants, and environmental initiatives. Pillar 1 direct payments provide income support that can improve your debt capacity and cash flow stability. Pillar 2 rural development programs offer investment grants that can cover 40 to 60% of eligible project costs, particularly for young farmers and sustainability initiatives. Specialized programs support specific objectives. The European Agricultural Fund for Rural Development provides grants for modernization and diversification. Life Plus programs support environmental innovations, and Horizon Europe funds research and development projects. Finally, venture capital increasingly focuses on funding innovative agritech solutions. This represents a newer but growing source of capital for operations willing to adopt cutting-edge technologies or develop innovative production methods. Venture capital brings not just money, but technical expertise, market connections, and strategic guidance. However, venture capital also requires giving up some control and accepting pressure for rapid growth and profitability. It's most appropriate for operations with scalable innovations and strong management teams. To illustrate effective capital combination, consider a successful farm expansion that blended multiple sources. A 250-hectare grain operation in Germany combined personal resources, 15%, agricultural bank financing, 45%, EU rural development grants 25%, and cooperative equipment sharing 15% to fund a €1.2 million expansion. This approach minimized individual risk while maximizing available support and maintaining operational flexibility. Effective debt management in agriculture requires understanding that agricultural operations have fundamentally different cash flow patterns, risk profiles, and asset characteristics than other businesses. Strategic loan matching represents the foundation of agricultural debt management. This involves aligning loan terms with asset lifespans to optimize capital efficiency and minimize refinancing risk. Long-term assets like land and buildings should be financed with long-term debt spanning 15 to 30 years. These assets appreciate over time and generate returns across decades, making extended repayment periods appropriate. Intermediate assets, including equipment and breeding livestock, require 3 to 7 year financing terms. Equipment depreciates predictably and has defined useful lives, while breeding livestock generates returns through multiple production cycles before replacement becomes necessary. Short-term assets such as inputs and feeder livestock should be financed with operating loans of less than 1 year. These assets convert to cash within a single production cycle, making short-term financing both appropriate and necessary for cash flow management. Seasonal repayment alignment accommodates the irregular income patterns characteristic of agriculture. Unlike businesses with consistent monthly revenue, agricultural operations often receive 60 to 80% of annual income during harvest periods lasting just a few months. Effective debt structures accommodate this reality through seasonal payment schedules that require minimal payments during production periods and larger payments during harvest. Balloon payment structures can align major debt service with harvest income. Interest-only periods during production phases preserve cash flow for operational needs. Interest rate balancing between fixed and variable debt provides protection against rate fluctuations while maintaining flexibility for early repayment. Variable rate debt provides opportunities to benefit from declining rates and offers greater flexibility for prepayment during profitable periods. Debt maturity layering reduces refinancing risk and provides financial flexibility by staggering loan maturity dates across multiple years. This prevents concentration of refinancing requirements during potentially unfavorable market conditions. Diversifying lender relationships provides access to different expertise, competitive terms, and backup financing financing sources. Agricultural operations benefit from relationships with agricultural banks, cooperatives, and equipment financing companies, each offering specialized products and market knowledge. Running a farm isn't like running any other business. Generic business metrics simply can't capture what makes agriculture unique. We need specialized performance indicators that reflect the reality of agricultural production. Let me walk you through what really matters. First, crop yield efficiency and land utilization ratios. Yield efficiency measures your actual production against potential production under optimal conditions. If you're getting 80 bushels per acre when optimal conditions could yield 120, that 33% gap points to specific opportunities, improved genetics, enhanced agronomic practices, or better management systems. Land utilization ratios tell you whether your available acreage is being productively deployed or lying underutilized. Second, input to output conversion metrics are critical for resource efficiency. In livestock operations, feed conversion ratios show how many pounds of feed produce 1 pound of gain. In crop production, fertilizer response ratios indicate nutrient use efficiency. Labor productivity measures across different enterprises reveal whether your workforce allocation matches your operational needs. These metrics identify where additional inputs generate positive marginal returns and where you've exceeded optimal application rates. But here's what separates good farms from great ones: integrated sustainability benchmarks. Environmental indicators include soil organic matter content, water use efficiency measured as crop per drop, biodiversity indices across your operation, and carbon sequestration rates in your soil. These aren't just feel-good measures, they're predictors of long-term productivity. Economic sustainability requires monitoring profitability trends over multiple seasons, debt service coverage ratios, and reinvestment rates that ensure operational viability. Your current ratio, working capital position, and asset turnover rates all matter for financial health. The power comes from integration. When you monitor yield efficiency alongside soil health measures or track inputs conversion ratios while watching your debt service capacity, you get actionable intelligence for both immediate decisions and strategic planning. Farmers who systematically track these diverse metrics and use them to guide continuous improvement, they're building resilient operations that perform today while protecting tomorrow. In the chapter 3.2 from this unit, you will find a set of indicators that could help you measure the performance of your agribusiness. Growing your agribusiness isn't something you just decide to do on Monday and start on Tuesday. It's a structured journey through 4 critical phases, and skipping steps is where most expansions fail. Let me focus on the first 2 phases that determine whether your expansion will succeed or struggle. Phase 1 is assessment, your foundation for everything that follows. You need brutal honesty here. Start with your current operations. What's your production efficiency? How well are you utilizing existing assets? Does your management team have capacity to handle more complexity? Because growth that overwhelms your current capabilities will create problems, not profits. Next, evaluate your market potential. Are demand trends favorable? Who are you competing against? What pricing opportunities exist? Here's the reality: you can be the most efficient producer in the world, but if you're entering a market you don't understand or can't access effectively, you're setting yourself up for failure. Finally, analyze your financial health, review your debt capacity, cash flow stability, and profitability trends over multiple years. Expansion needs capital not just for tractors and buildings, but for increased working capital and those inevitable surprises during implementation. Phase 2 is planning, where concepts become viable reality or reveal themselves as unworkable. Develop detailed budgets covering both capital investments, land, buildings, equipment, technology, and operational changes in labor, inputs, marketing, and administration. Don't underestimate those operational cost increases. Create financial projections with multiple scenarios. Model your best case, expected case, and worst case outcomes. Agricultural expansion is inherently uncertain, and scenario planning reveals potential problems while you can still adjust course. Finally, secure your financing before implementation begins. This means primary financing plus contingency funding sources and working capital arrangements that give you flexibility when reality doesn't match your projections. Get these two phases right and you're positioned for successful expansion. Rush through them and you're gambling with your farm's future. So you've assessed your situation and planned your expansion carefully. Now comes the hardest part, actually doing it. The implementation phase is where your plans meet reality. And let me tell you, this is where financial discipline separates successful expansions from disasters. You need robust financial controls in place, monitor budget variances regularly. Are you spending what you planned, where you planned? Track your cash flow week by week because construction delays or cost overruns can drain cash faster than you expect. Use milestone tracking to ensure implementation proceeds on schedule. If you're falling behind on milestones, you need to know immediately, not 3 months later. Here's the balance you must strike with expenditure tracking. Detailed enough to catch problems early, but simple enough that you'll actually maintain it during the chaos of construction and implementation. This is where technology becomes your friend. Modern software can automate much of this tracking and give you real time visibility. You shouldn't be waiting for monthly reports to know you have a problem. Keep your stakeholders, whether that's your banker, partners, or family, informed throughout. Regular reporting maintains their confidence and support when things get challenging, and they always do. Then comes the stabilization phase, getting from we built it to it's working. Operations normalization means integrating your new assets into daily routines. Train your staff properly, optimize your new systems, and refine processes until you're extracting maximum value from your investment. This doesn't happen overnight. Evaluate your actual return on investment rate against your projections. Where did you succeed? Where did reality differ from expectations? This analysis isn't just about judging the past, it guides your future decisions and helps you optimize current performance. Finally, consider refinancing opportunities. Once operations stabilize and demonstrate improved performance, you may qualify for lower cost permanent financing to replace expensive construction loans. That can significantly improve your long term profitability. Implementation and stabilization, execute with discipline, stabilize with patience, and measure everything. Every successful agricultural expansion starts with one critical document, a comprehensive budget. But here's what makes it different. You can't just copy a generic business template and call it done. Agricultural expansion budgets must account for biological constraints, seasonal patterns, and the unique risks that come with growing living things. Let me break down the three essential components you need to get right. First, capital expenditures, your one-time investments that create productive capacity. These are critical because they determine whether you can physically execute your expansion, but here's where people fail. They rush the numbers. You need multiple quotes, actual site visits, and consultations with technical experts who've done this before. Underestimate capital requirements, your project stops halfway through. Overestimate, you've tied up money you desperately need for working capital and contingencies. Neither scenario ends well. Second, operational costs, the ongoing expenses that determine whether your expansion actually generates positive cash flow. This is where I see the biggest mistakes. Operational costs seem small compared to that new barn or equipment purchase, so people underestimate them. But these costs determine your daily reality post expansion. Project your operational costs accounting for the learning curve. When you introduce new technology or scale up significantly, initial efficiency will be lower than you expect. Plan for higher labor costs and input costs during that adjustment period. It's temporary, but it's real. Third, financial preparedness through contingencies. Agricultural expansion faces more uncertainty than most business investments. Weather happens, equipment breaks, markets shift. Your contingency planning must reflect your specific risks. Weather dependent operations, build larger weather related contingencies, technology intensive expansion. You need technical risk reserves. Market dependent project, create price volatility buffers. When you integrate these three components properly, you get a budget that provides realistic guidance while maintaining flexibility for the unexpected. Because in agriculture, the unexpected isn't the exception, it's part of the business model. When you're planning agricultural expansion, capital expenditures aren't just line items on a spreadsheet, they're the foundation of your operations future. Let me walk you through the five major investment categories you need to understand deeply. First, land acquisition and preparation, typically your largest single investment. Land costs vary dramatically based on location, soil quality, water access, and development potential. You need to evaluate purchase prices against productive capacity and appreciation potential. Ask yourself, am I paying for dirt or am I investing in productive capacity? But here's what catches people off guard: the hidden costs. Closing costs add 3 to 5% to your acquisition through legal fees, surveys, and title insurance. Then comes land preparation. If you're buying undeveloped property, expect drainage, soil improvement, access roads, and utility installation to cost 20 to 30% of your purchase price. That €500,000 land purchase, budget another 100,000 to 150,000 euro just to make it functional. Second, building construction and modifications. Whether you're building new or retrofitting existing structures, you're looking at construction costs, permits, and professional services. Materials and labor are obvious, but don't underestimate permit costs and approval timelines. They vary wildly by location and can add months and significant expense. Architectural and engineering services aren't luxuries. They ensure regulatory compliance while optimizing functionality. And retrofitting existing structures, it often provides cost advantages but requires careful analysis of structural adequacy. That old barn might look solid, but can it actually support what you need? Third, machinery and equipment, the investments that directly impact your production capacity, labor requirements, and product quality. Here's where you need to think beyond sticker price. Balance initial cost against operating costs, reliability, and service availability. That cheaper tractor might cost you more in repairs and downtime. Installation costs, site preparation, utilities, training can add 10 to 20% to equipment costs. Consider your financing options carefully. Purchase, lease to or lease to own. Fourth, irrigation systems and water management infrastructure. These systems provide production stability and risk management that justify substantial investment. Your system design must account for current needs and future requirements, energy costs, automation potential, and regulatory compliance. Installation costs include wells, pumps, distribution systems, and control technologies. But think long term. Design for maintenance and upgrade capabilities from the start. A system that can't adapt to changing requirements becomes obsolete faster than you'd think. Finally, technology implementation, farm management software, IoT tools, automated systems. Technology investments often provide the highest returns but require the most careful implementation planning. And here's the critical point: the value depends heavily on proper implementation and utilization. Consider integration with existing systems. What training do your staff need? What ongoing support will you require? What are the upgrade pathways? Implementation costs include software licensing, hardware installation, training, and system integration. I've seen farms buy sophisticated technology that sits unused because they didn't budget for training and support. The technology itself is only half the investment. Training and support are equally important. Here's the bottom line: successful capital expenditure planning means understanding not just what things cost, but how they work together and what hidden costs lurk beneath surface prices. Each of these five categories requires detailed analysis. Rush through this planning and you'll face cost overruns, functionality problems, or worse, expansion that doesn't deliver the returns you projected. Take the time to get this right. Your operations' future depends on it. Here's the uncomfortable truth about agricultural expansion. Most people obsess over capital costs, that new barn, those tractors, but underestimate operational expenditures and operational costs. They determine whether your growth actually generates positive cash flow. Let me walk you through the five major operational cost categories that make or break expansion success. First, labor costs, and they're more complex than just adding bodies. When you expand, you're hiring new people whose productivity will initially be lower than your experienced workers. They need supervision, they make mistakes, they ask questions, budget for that reality. Training costs extend far beyond that first week orientation. You need ongoing skill development, safety certifications, and technology training so workers can actually use that new equipment you bought. And if you need seasonal labor during peak periods, expect to pay premium wages when agricultural labor demand is highest. Here's what catches everyone: labor efficiency drops during expansion. Your existing staff is adapting to new systems while training new employees. This transition period might last 6 to 12 months. Budget for lower productivity until operations stabilize, or you'll be scrambling to cover the gap. Second, increased inputs, the materials that keep operations running: seeds, fertilizers, feed, chemicals, packaging materials, all scale with production. Calculate volume discounts that reduce per unit costs, but also consider quality requirements. Sometimes expansion means upgrading specifications, which increases costs. Supply chain reliability becomes critical at larger scales. You might need premium suppliers or backup sources because running out of feed for 500 head of cattle is very different from running out for 100. Energy costs, electricity, fuel, heating scale with production volume, but often not proportionally. Larger operations can achieve efficiency improvements and spread fixed costs across higher volumes. Model this carefully in your projections. Third, marketing and distribution, the costs everyone forgets. You can produce all you want, but can you sell it profitably? New market entry requires understanding customer requirements, establishing distribution channels, and building brand recognition in unfamiliar territory. Promotional campaigns must be sustained long enough to establish market presence. That's not a 1 month effort, it's 6 to 12 months minimum. And these campaigns must remain cost effective relative to revenue generation, which requires careful monitoring and adjustment. Distribution network expansion may require investment in transportation, storage, and logistics capabilities. Can you actually get your product to these new markets efficiently? If not, your margins evaporate in shipping costs. Fourth, administrative overhead, the unsexy but essential costs. Office space, utilities, insurance, subscriptions all increase with operational scale, but they can also provide efficiency improvements through better systems and support. Insurance premiums will rise, reflecting higher asset values and potentially different risk profiles. A larger operation simply has more to insure. Professional services, accountants, lawyers, consultants may be required more frequently to support complex operations and regulatory compliance. Don't cut corners here. Adequate administrative support prevents small problems from becoming expensive disasters. Finally, regulatory compliance. Costs that often increase nonlinearly. Larger operations face more stringent requirements and oversight. It's not just about scale. Regulatory thresholds can trigger entirely new compliance regimes. New permits may be required for expanded operations. Existing permits might need modifications requiring technical studies and regulatory review. That's time and money. Certification programs, organic, sustainable quality standards require ongoing compliance monitoring and documentation. It's not a one-time cost, it's an ongoing operational expense. Someone has to maintain those records, schedule those inspections, and ensure continuous compliance. Here's my advice. When budgeting for expansion, be pessimistic about operational costs and optimistic about your ability to manage them once you know what they are. The farms that fail after expansion, they usually had adequate capital but underestimated operational costs. Don't let your impressive new facilities run at a loss because you didn't budget for the people, inputs, marketing, administration, and compliance needed to operate them effectively. Operational expenditures aren't just costs, they're the ongoing investment that transforms capital assets into profitable production. Let me tell you about expansion plans I've seen fail. They had solid business models, good management, adequate capital, but zero contingency planning. The first unexpected challenge and everything unraveled. Agricultural operations face unique uncertainties that generic business planning doesn't account for. You need carefully structured financial buffers. These aren't optional luxuries, they're essential components of responsible expansion planning. Let's start with seasonal variability allowances. Agricultural production rarely matches projections exactly. Weather variations, pest pressures, disease outbreaks, market timing factors, all beyond your control. That's why you need seasonal variability allowances of 15 to 20% built into your budget. Size these allowances based on historical variability in your specific operation and region. Crop operations typically require larger seasonal allowances than livestock operations due to weather dependence. Diversified operations may require smaller allowances because risk spreads across enterprises. If you're budgeting 500,000 euro in operational costs, you need 75,000 to 100,000 euro in seasonal buffers. That's real money, but it's what stands between smooth operations and crisis management. Next, weather related risk reserves. Climate change is making these more critical every year. We're seeing increasing frequency and severity of extreme weather events. Your reserves need to account for both direct production losses and indirect costs. Direct losses are obvious: crop damage, livestock losses, but indirect costs, replanting expenses, emergency harvesting, alternative feed sources when pastures flood, temporary housing for livestock during extreme conditions. These costs add up fast. Insurance may cover some losses, but rarely all costs. More importantly, insurance doesn't provide immediate cash for emergency responses. When you need to replant 200 acres next week, you can't wait 60 days for an insurance payout. Third, market fluctuation buffers. Agricultural markets are inherently volatile. Global weather, trade policies, currency fluctuations, economic conditions, all beyond your local control, all impacting your prices. You need buffers for both input costs and output prices. Input price buffers protect against cost increases after planting decisions but before harvest revenue. You committed to corn in March based on €4 fertilizer. By June, it's €6. Without buffers, that destroys your margins. Output price buffers provide flexibility to store commodities during poor markets or absorb transportation costs during disruptions. Wheat prices drop 30% at harvest. A buffer lets you store until markets recover rather than selling at a loss. How much buffer depends on exposure and risk tolerance, but 10 to 15% of expected input and output values provides meaningful protection. Finally, regulatory adaptation funds, the category everyone overlooks until urgently needed. Environmental regulations, food safety requirements, trade policies, they evolve continuously and often require immediate compliance regardless of timing convenience. These funds enable rapid response without disrupting cash flow or forcing hasty decisions. Real scenario: new environmental regulations require manure management system upgrades within 90 days. Without regulatory adaptation funds, you're choosing between compliance costs that devastate cash flow or operational permits at risk. Budget 5 to 8% of expansion costs for regulatory adaptation, more if you're in a heavily regulated sector. Here's how to think about total contingency planning. Add seasonal variability allowances, 15 to 20%, weather-related reserves sized to your risks, market fluctuation buffers, 10 to 15%, and regulatory adaptation funds, 5 to 8%. You're looking at total contingencies of 30 to 40% of operational costs. Does that sound high? The farms that survive unexpected challenges aren't luckier, they're better prepared. The expansion that succeeds isn't the one that never faces problems. It's the one with resources to address problems without derailing the entire operation. Contingency planning isn't pessimism, it's realism. It's recognizing that agriculture operates in an uncertain environment and building the financial flexibility to thrive despite that uncertainty. The question isn't whether you'll face unexpected challenges during expansion. The question is whether you'll have the resources to address them effectively. Let's discuss about expansion strategies. I will share a powerful strategy for managing the complexity and risk of agricultural expansion, phased expansion. I'll show you exactly why it works. The fundamental question: should you go all in on expansion at once or phase it over time? Most successful operations choose phasing. Here's why. First, cash flow management becomes dramatically more manageable. Phasing spreads capital outlays across multiple periods. Smaller initial capital requirements mean you're not betting the farm on perfect projections. Here's where it gets powerful. You generate revenue from early phases to fund later phases. That changes the entire financial dynamic. You're creating a self-funding growth cycle, not just spending down reserves, and you preserve financial flexibility. When unexpected opportunities or challenges arise, you have resources and options rather than being fully committed. Second, risk reduction through learning. Early phases teach you what actually works versus what you thought would work. You validate market assumptions before full commitment. If something isn't working, you can modify or abandon later phases. I've watched farms go all in based on market projections that turned out wrong. With phasing, they would have discovered this after phase one, not after mortgaging everything. Third, learning opportunities that improve outcomes. Each phase generates operational knowledge you cannot get from planning. You learn about actual costs versus projected costs, real efficiency versus theoretical efficiency, actual market response versus hoped for demand. You discover which technologies work in your operation, what market requirements actually entail, where staff capabilities need development. This learning reduces implementation risk and improves ultimate success. Would you rather plan phases 2 and 3 based on theoretical projections or actual data from phase 1? The difference in outcomes is substantial. Fourth, financing flexibility through stage-based funding. Different funding sources prefer different risk profiles. Proven phases access lower cost financing than speculative large investments. Stage-based financing may qualify for specific grant programs. You can use equipment leasing for early phases, then renegotiate based on demonstrated success. Banks look very differently at fund phase 2 of a successful expansion versus fund this entire untested expansion. Your cost of capital can be significantly lower. Fifth, operational adaptation without overwhelming your system. Massive change overwhelms existing operations. Staff can't adapt to everything at once. Management systems need to evolve gradually. Phasing allows organic adaptation. Staff adjusts to new responsibilities gradually. New equipment integrates systematically. You maintain control of current operations while building capacity. Let me show you how this works with an orchard expansion case study staged over 3 years. Year 1: infrastructure development. Install irrigation, prepare soil, improve access. These investments support all future planting. You're learning about soil, water resources, and infrastructure needs without the pressure of establishing trees simultaneously. Year 2: first phase tree planting. Plant one-third of available acreage. Now you're learning about variety performance, optimal spacing, care requirements. You discover which practices work before planting the remaining two-thirds. Year 3: complete planting. But here's the beauty. Early plantings begin production. You're generating revenue that supports final phase costs. You're validating market assumptions with actual sales before reaching full capacity. If markets aren't what you expect, you adjust varieties or strategies. This approach accomplishes multiple objectives. Capital requirements spread across 3 years. Learning from early phases improves later phases. Year 3 planting benefits from 2 years of experience. Revenue generation begins before full investment completion. Phased expansion isn't about being timid, so it's about being smart. You're managing complexity, reducing risk, creating learning opportunities, improving financing terms, and allowing operational adaptation. Each phase builds on previous success rather than betting everything on initial projections. The farms that expand successfully aren't the ones that move fastest, they're the ones that move deliberately, learning as they go, building sustainable growth rather than risky leaps. Consider phasing your expansion. Your operations' future depends on smart growth strategies. Here's a mistake I see constantly: farmers getting a single quote for major equipment or construction, liking the number, and moving forward. 6 months later, they're over budget and wondering what happened. Cost validation through multiple quotes isn't bureaucracy. It's essential protection against budget overruns and the key to optimal value for your expansion investments. Let's start with price accuracy. A single quote tells you what one supplier wants to charge you. Three quotes tell you what the market actually costs. That difference matters enormously. Competitive bidding reveals true market pricing. Industry standards recommend at least three quotes for any expense exceeding 5% of your total budget. Single source pricing frequently deviates 15 to 25% from competitive market rates. Think about that on a €200,000 equipment purchase. A 20% deviation is €40,000, money that could fund operational contingencies or additional improvements, but price is only part of the story. Supplier reliability matters just as much. The cheapest quote from an unreliable supplier is expensive. Assess vendor capabilities, service quality, and financial stability. Are you building partnerships for long-term success or chasing short-term cost savings? Check references. Talk to previous customers about actual experience. Evaluate technical capabilities. Can they deliver what they're promising? What happens when something breaks at 2 a.m. during planting season? That rock bottom quote from a financially unstable company. You'll pay for it when they can't honor warranties or provide parts 5 years from now. Third, negotiating leverage increases dramatically with multiple qualified suppliers. When suppliers know they are competing, you gain leverage beyond price. Negotiate favorable payment terms that improve cash flow, delivery schedules matching your operational needs, warranty provisions that actually protect you. I've watched farmers negotiate extended payment terms, deferring €50,000 in costs to the next fiscal year, purely because they had competitive quotes. That's real financial flexibility. Fourth, specification refinement happens through the quote comparison process. Different suppliers interpret your requirements differently, and that's valuable. You'll identify unnecessary features that increase costs without adding value. You'll discover missing requirements you hadn't considered. Example, you request quotes for a grain handling system. Supplier A includes automated monitoring. Supplier B proposes simpler mechanical systems. Supplier C suggests modular design allowing future expansion. You're not just comparing prices, you're comparing fundamentally different approaches. Finally, exploring alternatives becomes possible when you actively seek multiple quotes. You might discover newer technologies, different implementation approaches, or innovative suppliers offering significant advantages. Real example: a farm planning livestock facility expansion requested quotes for traditional barn construction. Through the quoting process, they discovered pre-engineered steel buildings that reduced construction time by 40%, cost 20% less, and provided better durability. They never would have explored this with single source purchasing. Here's my practical recommendation. For expenses exceeding 5% of total budget, obtain at least three quotes. Research potential suppliers first. Identify those with relevant experience and solid reputations. When quotes arrive, don't just compare bottom line numbers. Create a comparison matrix including price, payment terms, delivery schedules, warranty provisions, and supplier reliability factors. Check references thoroughly. find customers they don't list, and ask about honest experience. Cost validation isn't about finding the cheapest option, it's about making informed decisions that optimize value and reduce risk. The few weeks invested in obtaining and evaluating multiple quotes can save months of problems and tens of thousands of euros during implementation. Here's where most expansion planning goes wrong. Farmers base their projections on what they hope will happen, not on what actually happens in their operation. Historical analysis provides the foundation for realistic financial projections. And I mean your historical data, not industry averages, not theoretical maximums, not what your neighbor achieved. Your actual performance data. Start with at least 3 years of historical performance data from your operation. Why 3 years minimum? Because 3 years captures normal variability while identifying genuine trends rather than temporary fluctuations. You had a great year in 2023? Was it an outlier or part of a pattern? 3 years tells you the difference. 5 to 10 years provides even better insights into long-term patterns and cyclical variations. If you have a decade of records, use them. This data reveals actual yield patterns, input requirements, labor needs, and cost structures specific to your operation, not generic data, your data that enables accurate scaling projections for expansion. Let me show you what historical analysis actually reveals. First, resource efficiency through input-output relationships. How much fertilizer did you actually use per bushel produced over the past 5 years? What were your labor productivity trends? How efficiently did you utilize equipment? This identifies your best performing periods that can be replicated at larger scale. It also identifies problematic patterns needing correction. Maybe labor productivity drops dramatically during harvest. That's critical information for expansion planning. Second, growth trajectories become apparent. Is your performance improving, declining, or stable over time? This informs realistic expansion expectations. I've seen farmers plan aggressive expansion while their historical data showed declining yields for 3 consecutive years. They assumed expansion would reverse that trend. It didn't. Historical analysis would have revealed they needed to fix current problems before expanding. Third, analyzing past anomalies. This is where contingency planning gets real. Look at extreme weather events, disease outbreaks, market disruptions in your history. How did your operation actually respond? Which disruptions caused lasting impacts versus temporary setbacks? How long did recovery require? Concrete example, a farm analyzing drought response over 10 years discovered they recovered fully within 1 season from moderate drought, but required 2 to 3 seasons after severe drought. That's actionable information for contingency planning that generic assumptions can't provide. Fourth, grounded yield expectations. This is critical. Your historical yield data provides significantly more accurate revenue projections than theoretical maximums or regional averages. Regional averages might show 180 bushels per acre, but what did you actually achieve over 5 years? Maybe you averaged 165. That's your realistic baseline. Your neighbor might hit regional averages with different soil types or irrigation you don't have. Your historical data reflects your reality. Here's how to implement this practically. Gather at least 3 years of data, 5 to 10 if possible, covering yields, input costs, labor hours, equipment usage, and revenues. Calculate averages, but also examine ranges and variability. What were your best years? Worst years? What caused the differences? Identify trends over time. Are yields improving? Are input costs rising faster than revenues? Document anomalies and your responses. When problems occurred, how did you address them? What worked? How long until operations normalized? Use this analysis to build financial projections. Your expected case should reflect your historical averages. Your best case should reflect your best historical performance, not industry maximums. Your worst case should reflect actual challenging years you've experienced. Historical data improves forecast accuracy and supports robust contingency planning by providing empirical foundations rather than optimistic assumptions. Optimistic assumptions feel good during planning but lead to disappointment and financial stress during implementation. Historical analysis might be less exciting, but it's realistic. And realistic planning leads to successful expansion. Base your expansion on evidence from your operation, not hopes about what might be possible. Let me ask you something. When you planned your last expansion, did you create one budget projection and assume everything would go exactly according to plan? If so, you're not alone. But here's the reality: single point projections rarely match what actually happens. Developing multiple budget scenarios prepares you for diverse outcomes and creates flexible response strategies before you need them. Think of scenario planning as proactive management rather than reactive crisis response. Instead of scrambling when conditions change, you've already thought through responses. That reduces stress and improves outcomes during challenging periods because you're executing a plan, not improvising under pressure. Let's break down the three scenarios you need. First, best case scenarios. What happens when everything performs better than expected? This isn't fantasy planning. Best case scenarios identify resource requirements and decision triggers for rapid expansion when conditions are exceptionally favorable. If markets surge, can you quickly capitalize? Do you have financing prearranged? Can you secure additional inputs? Best case planning ensures you capture maximum benefit from favorable conditions rather than missing opportunities because you weren't prepared. Second, expected case scenarios, your primary planning foundation. These should represent the most likely outcomes based on your historical performance and current market conditions. Base decisions on realistic operational and financial assumptions, not optimistic hopes. Expected case scenarios guide resource allocation and operational planning under normal conditions. They also provide benchmarks for measuring actual performance. When reality diverges from expected case, you know immediately and can respond. Third, worst case scenarios. Stress testing your financial sustainability. This is where most people get uncomfortable, but it's critical. Worst case planning reveals potential breaking points in cash flow before they happen. Where are your vulnerabilities? What are critical resource requirements during crises? Let me be specific. If corn prices drop 30% and yields fall 20% simultaneously, can you survive? For how long? What would you cut first? What's non-negotiable? Answering these questions before crisis hits enables survival during difficult periods and positions you for recovery when conditions improve. But scenarios aren't just financial projections. They need operational responses and contingency triggers. Define clear decision points. For example, if wheat prices fall below 180 euros per ton, we'll defer equipment purchase and reduce fertilizer applications by 15%. Or if yields exceed 200 bushels per acre, we'll accelerate phase 2 by 6 months and negotiate expanded storage. These predetermined triggers provide clear guidance for management decisions under different conditions. You're not debating whether to act, you're executing the plan you developed when you had time to think clearly. Scenario planning also aligns stakeholder expectations. Your banker, partners, or family need to understand potential outcomes. When everyone knows the best expected and worst case scenarios up front, difficult decisions during challenging periods cause less conflict. You're not surprising stakeholders with bad news. You're updating them on which scenario is unfolding. Here's my practical recommendation. Develop 3 complete scenarios with financial projections and operational responses. Make expected case your primary guide. Use best case to prepare for opportunities. Use worst case to identify vulnerabilities and develop survival strategies. Update scenarios annually as conditions and your operation evolve. The scenario planning process is as valuable as the scenarios themselves. It forces rigorous thinking about your operations' resilience and flexibility. Single point projections assume certainty in an inherently uncertain business. Scenario planning acknowledges reality and prepares you to thrive regardless of which conditions emerge. Technology has transformed agricultural financial management. Let me show you how modern tools enable proactive management rather than reactive problem solving. First, real-time budget monitoring, immediate detection of variances. Traditional budgeting meant waiting until month end to discover problems. By then, you've missed opportunities to correct course. Modern technologies provide dashboard displays of key financial metrics with automated alerts for budget variances. You see immediately when costs exceed projections projections or revenues fall short. That enables corrective action while you still have options, not after issues become critical. Second, operational and financial integration, connecting production decision with financial implications. Traditionally, production and financial management operated in silos. Your farm manager made decisions based on agronomic factors. Your accountant tracked financial results. They rarely connected in real time. Modern integration eliminates these silos. When you make production decisions, you immediately see financial implications. This enables precision resource allocation based on real time profitability analysis rather than historical assumptions or intuition. Should you apply additional nitrogen? The system shows you current input costs, expected yield response, and projected profitability, all in real time. That's holistic decision making, optimizing both operational and financial performance. Third, predictive analytics, forecasting potential issues before they develop into crises. Analytics identify emerging patterns in costs, productivity, or market conditions that indicate potential problems or opportunities requiring attention. Maybe your fuel costs are trending 15% above budget over 3 months. Predictive analytics flag this trend early, enabling you to renegotiate contracts, adjust operations, or revise budgets. Early warning systems enable preventive action rather than crisis response. Fourth, automation for financial accuracy, reducing errors while freeing your time. Automated systems reduce manual data entry errors, provide consistent calculation methods, and maintain detailed audit trails supporting both management and compliance requirements. Manual data entry creates errors. Automation eliminates these while freeing management time for strategic decisions rather than administrative tasks. Let technology handle routine processes so you focus on running your operation. Finally, seasonal tool selection tailored to agricultural cycles. Generic business software doesn't understand planting seasons, harvest timing, or livestock production cycles. Choose technologies that align with farming's unique demands and patterns rather than generic business cycles. Your financial tools should understand that expenses concentrate during planting, revenues arrive at harvest, and cash flow patterns follow agricultural rhythms. Modern technology integration transforms budget management from reactive to proactive, from siloed to integrated, from error prone to automated. The farms leveraging these technologies make better decisions faster, catch problems earlier, and operate more efficiently. That's competitive advantage in modern agriculture. Here's a common pattern. Farms create detailed expansion budgets, then file them away and hope everything works out. 6 months later, they're surprised when reality doesn't match projections. Regular quarterly budget reviews are critical for catching deviations early, before small problems compound into threats that derail your expansion. Why quarterly? It's the right balance. Monthly reviews are too frequent for meaningful trend analysis. You're reacting to noise rather than signals. Annual reviews? Too infrequent for timely intervention when problems develop. Quarterly provides systematic evaluation with sufficient time between reviews for meaningful analysis and corrective action. First purpose of reviews: validating investments. Compare actual costs against budgets. Evaluate performance against projections. Ask the critical question: are anticipated benefits materializing as expected? If implementation milestones aren't being met, you need to know now. Maybe that new equipment isn't delivering promised efficiency. Maybe construction costs are running 15% over budget. Early detection enables course corrections when you still have options. This process also identifies successful approaches that should be expanded or replicated. Maybe one phase is exceeding expectations. That's valuable intelligence for planning subsequent phases. Second purpose: cash flow management and reforecasting. Confirm cash flow sufficiency and reforecast as needed. Your initial projections were based on assumptions. Now you have actual data. Use it. Project cash flow forward at least 6 months to identify potential problems while there's still time to arrange additional financing or modify operations. Don't wait until you're in crisis mode to discover you'll be short on cash in 90 days. Regular reforecasting updates projections based on actual performance and changing conditions rather than relying on increasingly outdated initial projections. Markets change, weather happens, your forecast should reflect current reality. Third purpose, stakeholder communication. Regular, transparent communication with lenders, investors, family members, and business partners builds trust, reduces surprises, maintains confidence during challenging periods when you need support most. I've watched farmers lose financing not because their projects were failing, but because they stopped communicating when problems emerged. Lenders interpret silence as trouble. Transparent reporting demonstrates professional management and may actually improve access to additional financing when needed. Fourth purpose, leadership alignment. Bridge the gap between financial planning and operational execution by involving both financial and operational leadership in reviews. Your accountant needs to hear from your farm manager. Your operations team needs to understand financial constraints. This collaboration ensures financial decisions align with operational realities, while operational decisions consider financial implications. Cross functional reviews improve decision quality by combining financial expertise with operational knowledge and market understanding. Here's my practical framework for quarterly reviews. Schedule them in advance. Make them non-negotiable. Prepare variance analysis comparing actual to budget for all major categories. Project cash flow forward 6 months. Update full year forecasts based on actual performance. Document decisions and action items. Involve key stakeholders, financial manager, operations manager, relevant department heads. Keep reviews focused, 2 hours maximum. Follow up on previous action items first, then review current period, then plan adjustments. Regular reviews transform budgets from static documents into dynamic management tools. You're not just tracking numbers, you're managing your expansion proactively, catching problems early, capitalizing on successes, and building stakeholder confidence through transparency. The farms that succeed with expansion aren't the ones with perfect initial plans. They're the ones that monitor progress systematically and adjust course when needed. Agricultural expansion isn't like opening another retail store or adding a production line. There are specific considerations that distinguish farming from other businesses, and ignoring them leads to expensive failures. First, weather contingency planning, and this is becoming more critical every year. Climate change is increasing both frequency and severity of extreme weather events. Your weather planning needs larger contingencies than historical experience suggests. What happened once every 20 years might now happen every 5. Plan for both direct production impacts and indirect effects. Extreme weather in another region can disrupt transportation, create supply chain problems, and cause market volatility that affects your operation even when your fields are fine. Budget for these ripple effects. Second, production lag considerations, especially critical for perennial crops. Planting tree fruits, nuts, or perennial crops. You're looking at 3 to 5 years before significant income begins. Your financing must bridge that gap between investment and revenue generation. That's fundamentally different from annual crop operations, where you see returns within months. Even annual crops face production lags between planting investments and harvest revenue. Careful cash flow management and working capital planning are essential because your money is tied up in the field for months before you see returns. Third, understanding nonlinear input scaling. This catches everyone. Many assume doubling production means doubling inputs. Wrong. Input requirements often don't scale proportionally. Labor requirements may increase more than proportionally due to management complexity, training needs, and coordination challenges at larger scales. Managing 5 employees is not just double managing 2 employees. The complexity multiplies. Equipment efficiency may decrease initially as operators learn new systems. Budget for higher operating costs during this transition period. That new technology might eventually improve efficiency, but expect a learning curve first. Fourth, compliance cost management. Environmental regulations often have different requirements at different operational scales. Larger operations face more stringent oversight and reporting requirements. What you could do at smaller scale may not be permitted at larger scale. Food safety and quality standards may require additional certifications as you grow and access new markets. Exporting, selling to major retailers, expect new compliance requirements. Budget 5 to 10% of expansion costs for regulatory adaptation and compliance. Finally, market absorption validation. Don't skip this. Can the market actually absorb your increased production without price suppression? I've seen farms double production only to discover local markets couldn't absorb the volume without significant price decreases. Their revenue increased 40% instead of 100% because prices fell. Market analysis should confirm that increased production can be absorbed without significantly depressing prices or requiring costly market development investments. And evaluate distribution capacity. Can you actually move increased production to markets efficiently and cost effectively? These considerations separate successful agricultural expansion from expensive mistakes. Weather contingencies, production lags, nonlinear scaling, compliance costs, market absorption. They're specific to agriculture and must be integrated into your planning. Generic business expansion models don't account for these factors, which is why farming requires specialized planning approaches. Take time to address each consideration thoroughly. Your expansion's success depends on it. Forecasting agricultural revenue isn't like forecasting widget sales. You can't just look at last year's numbers and add 10%. Agriculture is more complex, which is why you need three interconnected methodologies working together. First, yield-based forecasting, understanding your physical production. Agricultural revenue fundamentally depends on what you actually produce, and production varies based on weather, soil conditions, pest pressures, and management practices that you must quantify and project. Analyze your historical production data and climate impacts. What were your yields over the past 5 to 10 years? What caused variations? Can you separate normal variability from long-term trends? Here's what makes this challenging. You need to account for both random variability and genuine trends. Maybe your corn yields improved 5% over 5 years due to better genetics and management. That's a trend you can project forward. But individual years varied 15% around that trend due to weather. That's variability you need to model. Incorporate technological improvements, climate change impacts, and management evolution into projections. Your yields 5 years from now won't just reflect historical averages, they'll reflect ongoing changes in how you farm and the environment you're farming in. Second, price trend analysis, capturing market movements beyond your control. Agricultural commodity prices exhibit both predictable seasonal patterns and unpredictable market volatility. You need to analyze these separately. Seasonal patterns result from production cycles, storage costs, and consumption patterns. Corn prices typically decline during harvest and increase during spring. Livestock prices follow predictable patterns around holidays. These seasonal movements are relatively predictable and should be incorporated into revenue projections, but long-term trends reflect fundamental changes in supply, demand, trade policies, and economic conditions. These create multi-year price cycles that affect profitability dramatically. Are prices in a 5-year uptrend or downtrend? Where are we in the cycle? Don't just use last year's average price. Analyze both seasonal timing and long-term positioning to develop realistic revenue projections that account for market dynamics. Third, diversification modeling, balancing your product mix. This methodology enhances revenue stability and mitigates risks associated with relying on a single enterprise or narrow product mix. Examine correlations between different enterprises. Some commodities move together in price, others move independently or inversely. Combining enterprises with low correlation provides more stable overall revenue despite variability in individual components. For example, if you produce both corn and livestock prices often rise when feed costs fall and vice versa. This natural hedge stabilizes revenue better than producing only corn or only livestock. Consider service integration opportunities, agritourism, direct marketing, custom operations, value added processing. These can provide revenue streams with different risk profiles and seasonal patterns than commodity production. Direct marketing may provide higher margins but requires different skills and market development. Agritourism revenue peaks during different seasons than crop sales. Value added processing creates year round revenue rather than harvest time concentration. Here's why integrating all three methodologies matters. Yield based forecasting alone ignores market conditions. Price trend analysis alone ignores whether you can actually produce the volume. Diversification modeling alone doesn't address fundamental production and pricing realities. Together, these three methodologies provide comprehensive revenue projections that account for production uncertainty, market volatility, and strategic opportunities for revenue enhancement and risk management. When forecasting revenue for expansion, use all three approaches. Your projections will be more realistic, your planning more robust, and your decisions better informed. Yield-based forecasting isn't guesswork, it's a structured approach with four essential components that together provide realistic production projections. Let me walk you through each. First, historical yield analysis over 5 to 10 years, establishing your baseline. You need to understand past performance to project future production, but it's not just about calculating averages. Your historical analysis must account for changes over time. Did you switch varieties, adopt new management practices, face different weather patterns, implement new technology? All these factors affect yield trends. Conduct statistical analysis that identifies outlier years with explanations. That exceptional year in 2020, was it superior management or just perfect weather you can't count on repeating? Calculate both mean and median yields and develop trend lines accounting for systematic improvements or declines. For example, if your corn yields improve from 150 to 170 bushels per acre over 10 years due to better genetics and precision agriculture, that's a genuine trend you can project forward. But if yields just bounce randomly between 140 and 180, that's variability without clear trend. Second, climate adjusted projections accounting for environmental variability. Historical averages are useful, but weather introduces significant variability. You need climate modeling using long-term weather data to estimate probability distributions for temperature, precipitation, and extreme events affecting crop development. What's the probability of adequate spring moisture, drought during critical growth periods, excessive heat during pollination? These probabilities should adjust your yield projections. Seasonal forecasting incorporates current weather conditions into short-term projections. If you're already experiencing drought in June, adjust your harvest expectations now rather than waiting until September to discover the problem. This enables real-time adjustments to marketing and management strategies. Climate-adjusted projections ensure your forecasts account for environmental reality, not just historical averages that may not reflect current or future conditions. Third, technology impact assessment, quantifying productivity gains. New technology promises improvements, but you need realistic assessment of actual impact. Technology evaluation must account for learning curves and optimization periods. That new precision planter might eventually improve yields 8%, but year one might only show 3% improvement while you learn optimal settings. Account for these learning curves in projections. Also consider interaction effects between different technologies. Precision planting combined with variable rate fertilization might produce greater benefits than either technology alone, or they might create complications limiting individual technology benefits until you optimize the complete system. Adoption timeline modeling recognizes that technology benefits often require multiple years to fully realize as management systems adapt and operational experience develops. Don't project full benefits immediately. Model realistic adoption curves. Fourth, Market demand correlation, aligning production with market requirements. You can produce record yields, but if they don't meet market requirements, you won't capture full value. Quality requirement analysis examines market specifications for grades, standards, and characteristics affecting pricing. Are you producing feed grade corn when food grade commands premium pricing? Are your wheat protein levels meeting buyer specifications? Quality matters as much as quantity for revenue projections. Volume correlation ensures production plans match market absorption capacity. If you're planning to double production, can your markets absorb that volume without price suppression? Do you have distribution capabilities to move increased production efficiently? I've seen farms achieve record yields only to discover local markets couldn't absorb the volume without significant price discounts. Their revenue increased 30% instead of 100% because they exceeded market absorption capacity. Here's why integrating all four components matters. Historical analysis alone ignores climate variability and technology changes. Climate projections alone ignore whether you can actually achieve those yields with current practices. Technology assessment alone ignores whether markets want what you're producing. Together, these four components provide comprehensive yield-based forecasting that accounts for past performance, environmental factors, technological improvements, and market realities. Use this structured approach for realistic production projections that support sound financial planning and strategic decision making. Understanding agricultural price dynamics requires analyzing five critical elements. Let me show you how these work together to improve your revenue forecasting. First, seasonal price patterns, predictable annual variations. Agricultural commodities exhibit distinct seasonal patterns driven by production cycles, storage costs, and consumption trends. These seasonal movements can explain 30 to 45% of short term price fluctuations. Map typical price movements throughout the year to identify optimal marketing windows. Corn prices typically decline during harvest when supply floods markets, then strengthen through spring as storage costs accumulate. Quantify these seasonal premiums or discounts for your specific commodities. Storage economics influence these patterns. Storage costs, quality deterioration, and carrying costs create pressure for post harvest sales. But delayed marketing during periods of seasonal strength can capture significant premiums. Understanding this trade off optimizes your marketing timing. Second, long term price trends, multi year cycles affecting sustained profitability. Beyond seasonal patterns, long term trends reflect macroeconomic factors and structural consumption changes. Macroeconomic influences include currency fluctuations, interest rates, energy costs, and economic growth patterns affecting both your production costs and consumer purchasing power. When your currency weakens, exports become more competitive, supporting prices. Structural consumption changes result from population growth, dietary transitions, and economic development in emerging markets. Rising protein demand in developing economies represents a key driver supporting sustained price strength for feed grains and livestock products. These aren't temporary fluctuations, they're long term trends affecting your planning horizon. Third, value added opportunities, capturing premiums beyond commodity pricing. Processing, packaging, and certification can generate price premiums of 15 to 40%, significantly enhancing revenue potential. Processing premiums reward investments in cleaning, grading, packaging, and branding that differentiate your products in consumer markets. That bushel of wheat becomes specialty flour commanding premium pricing. Certification programs for organic, sustainable, or quality standards provide access to premium markets rewarding production practices aligned with consumer preferences. These certifications require investment but can substantially improve margins. Direct marketing eliminates intermediary costs while capturing retail margins, potentially doubling farm gate prices for products marketed directly to consumers. That's powerful revenue enhancement if you have market access and marketing capabilities. Fourth, contract pricing mechanisms balancing stability with profitability. Forward contracts and marketing agreements can stabilize revenue by reducing volatility 25 to 40%, though potentially slightly lowering average returns. Forward contracting provides price certainty before production begins. You know exactly what you'll receive, enabling confident planning, but you sacrifice potential gains from favorable market movements. If prices surge after you contract, you miss those gains. Marketing agreements may provide price floors with upside participation, combining some price protection with market opportunity. These hybrid approaches balance risk management with profit potential. Fifth, integrating these price dynamics for strategic decision making. Effective revenue forecasting combines seasonal patterns, long term trends, value addition opportunities, and risk management tools. Don't just use last year's average price, consider where we are in seasonal cycles. Evaluate long term trend positioning. Assess value added opportunities available to your operation. Determine appropriate contract coverage, balancing stability needs with market exposure. This integration enables development of marketing strategies that optimize revenue while managing price risk through diversified approaches and timing flexibility. Here's the practical application. Use seasonal analysis to time spot market sales. Apply long term trend analysis to multi year planning. Evaluate value added opportunities, matching your capabilities. Employ contract mechanisms appropriate to your risk tolerance. Comprehensive price trend analysis transforms revenue forecasting from guesswork into strategic planning, improving both accuracy and profitability. Relying solely on commodity production is risky. Let me show you 5 complementary strategies that create resilient revenue models, providing both stability and growth opportunities. First, risk management through diversification, balancing your portfolio. Diversification analysis examines return correlations between different enterprises. The goal is identifying combinations where poor performance in one area is offset by stable or strong performance in others. For example, livestock prices often rise when feed grain prices fall, creating natural hedging. Optimized diversification models can achieve 10 to 20% higher risk adjusted returns by balancing return correlations, resource allocation efficiency, and management capacity. Product mix optimization balances cash flow timing, resource requirements, and market risks across multiple enterprises rather than concentrating everything in single high risk ventures. That spreads your risk intelligently. Second, service integration, expanding beyond traditional production. Agritourism, educational programs, and consulting can increase farm revenue by 25 to 130% while reducing income volatility. These services create revenue streams with different seasonal patterns and risk profiles than commodity production. Agritourism services include farm tours, accommodation, event hosting, and recreational activities, capturing value from urban consumers seeking rural experiences. Educational programs serve schools and corporate groups while building brand recognition. Consulting services leverage your operational expertise to serve other farmers, providing knowledge-based income. Custom operation services utilize your equipment and labor during slack periods, generating additional income while improving asset utilization efficiency. Third, byproduct monetization, turning waste into revenue. Byproduct monetization can boost revenue by 5 to 15% while simultaneously lowering waste management costs. That's dual benefits enhancing overall profitability. Crop residue utilization includes selling straw or corn stalks for animal bedding or biomass energy. Livestock byproducts include manure sales and breeding services. Energy generation from agricultural waste through anaerobic digestion or solar installations creates additional revenue while supporting sustainability objectives. What you previously paid to dispose of might now generate income. Fourth, seasonal revenue balancing, smoothing income throughout the year. Counter-seasonal operations and storage optimization can improve capacity utilization by 30 to 40%, supporting year-round income generation. Counter-seasonal enterprises utilize facilities, labor, and management during periods when primary operations are dormant. Storage optimization enables marketing flexibility, capturing seasonal price premiums while providing cash flow during off-seasons. Processing and value addition activities can continue year round using stored raw materials, providing employment and revenue during traditional slack periods. This transforms your operation from seasonal to year round income generation. Fifth, building a resilient revenue base, combining all strategies. The power comes from integration. Diversification reduces dependence on any single revenue source. Service integration provides countercyclical income. Byproduct monetization improves margins. Seasonal balancing smooths cash flow. This comprehensive approach creates synergies between different enterprises that enhance overall operational efficiency and profitability. You're not just adding revenue streams, you're building a resilient business model that withstands market volatility, weather challenges, and economic uncertainty. Here's the practical takeaway: evaluate which strategies match your resources and market access. You don't need to implement everything simultaneously. Start with one or two service integrations or byproduct opportunities. Gradually build diversification as management capacity allows. The most resilient agricultural operations aren't the largest or most efficient at single enterprises. They're the ones with diversified integrated revenue models that ensure long-term stability and adaptability. Debt management can make or break agricultural expansion. Let me show you 5 strategic elements that optimize your financial structure while minimizing risk. First, align loan terms with asset lifespans. This is fundamental. Long-term debt for land and buildings should span 15 to 30 years, matching the lengthy economic life of these appreciating assets that generate returns across decades. Intermediate financing for equipment and breeding livestock requires 3 to 7 year terms, aligning with useful life and replacement cycles. Short-term loans for inputs and feeder livestock should be repaid within 1 year, as these assets convert to cash within single production cycles. Why does this matter? Alignment ensures repayment schedules match asset productivity. Imagine financing a 20-year building with a 5-year loan. The payment burden would crush your cash flow. Match asset life to loan terms. Second, match repayment schedules to agricultural cash flow cycles. Agriculture has irregular income patterns. Uniform monthly payments ignore this reality and create unnecessary financial stress. Seasonal payment schedules concentrate debt service during harvest periods when cash flow is strongest, while minimizing payments during production phases when cash is limited. Balloon payment structures defer principal until harvest when large cash inflows can accommodate substantial payments. Interest-only periods during production phases preserve cash flow for operational needs. This approach can reduce financial stress by up to 60% compared to uniform monthly schedules that ignore agricultural cash flow patterns. Third, balance fixed and variable interest rates. Typically maintain 50 to 70% fixed rate debt. Fixed rate debt provides predictable costs, supporting budgeting and planning during volatile periods. Variable rate debt offers opportunities to benefit from declining rates with greater prepayment flexibility. The optimal balance depends on current rate environment and your risk tolerance, but generally favors fixed rate emphasis for operational stability. You want predictability for core operations while maintaining some flexibility. Fourth, layer debt maturities by staggering loan due dates and diversifying lenders. This lowers refinancing risk by 30 to 45% while reducing dependency on single financial institutions. Maturity diversification prevents concentration of refinancing requirements during potentially unfavorable market conditions when credit availability may be restricted. Don't have all loans maturing the same year, spread them out. Lender diversification provides access to different expertise, competitive terms, and backup financing sources. Multiple banking relationships spread risk and create competitive tension, improving your terms. Fifth, monitor key financial ratios systematically. Debt to asset ratios should remain below 60% for established operations, with optimal levels of 30 to 60% depending on growth phase. Conservative operations maintain ratios below 40% for maximum resilience. Debt service coverage ratios should exceed 1.5 for healthy operations, minimum 1.25 during expansion phases. This means your earnings should cover debt payments at least 1.5 times. Interest coverage ratios must remain above 2.5, preferably exceeding 3.5 to ensure adequate earnings relative to debt obligations and maintain access to favorable financing terms. Strategic tools optimize your debt management further. Debt consolidation can reduce total interest costs by 5 to 15% while simplifying payment schedules. Interest rate hedging through swaps or caps can reduce borrowing cost volatility by 30 to 60% during monetary policy uncertainty. Prepayment strategies during profitable years can reduce total financing costs by 10 to 20% over 10-year periods while accelerating equity building. Regular refinancing analysis identifies opportunities when available rates are 75 to 100 basis points below existing rates. Here's the bottom line. Effective debt management isn't about minimizing debt, it's about optimizing debt structure to support sustainable growth while managing risk. Align loan terms with assets, match payments to cash flow cycles, balance fixed and variable rates, layer maturities, and monitor ratios systematically. The farms that expand successfully use debt strategically as a growth tool, not as a burden that constrains operations. We've covered substantial ground today, from fundamental challenges facing modern agriculture to sophisticated strategies for managing expansion and debt. But let me distill this into what really matters. Successful agricultural enterprises don't leave financial success to chance. They don't rely on intuition alone or hope that good farming practices automatically translate to profitable operations. They combine disciplined financial planning with strategic growth management using the specialized approaches we've discussed. Here's the truth. Financial forecasting in agriculture isn't just about numbers, it's about creating resilience and adaptability in an increasingly complex global food system. Markets fluctuate, weather becomes more unpredictable, regulations evolve, input costs surge. The operations that thrive over the coming decades will be those that master financial planning principles while maintaining the agricultural expertise that defines our industry. You can't control weather, you can't control commodity markets, but you can control how prepared you are to navigate these challenges. So, where do you start? Don't try implementing everything simultaneously. That's overwhelming and sets you up for failure. Start with the basics and build gradually. Develop historical analysis capabilities. Gather your production and financial data from the past 3 to 5 years. Analyze what actually happened in your operation, not what you hoped would happen. Implement systematic budgeting processes. Move beyond annual guesswork to quarterly reviews that catch problems early and identify opportunities quickly. Establish relationships with appropriate financing sources. Diversify your lender relationships before you need them urgently. Build those connections during good times so they're available during challenging periods. Build these capabilities gradually while maintaining focus on operational excellence. Your farmers first. Financial management supports your agricultural mission, it doesn't replace it. But here's what excites me about the future. The next generation of agricultural operations like yours, are combining traditional agricultural knowledge with modern financial management expertise. You understand soil, health, and crop rotation. You also understand cash flow management and debt structuring. That combination is powerful. By implementing these strategies, you're not just building profitable businesses, you're contributing to a more resilient and sustainable agricultural sector that can meet the challenges of feeding a growing global population. That matters. My challenge to you: keep learning, keep growing. Apply one principle from today's session in your operation within the next month. Just one. Maybe it's obtaining multiple quotes for your next major purchase. Maybe it's conducting historical yield analysis. Maybe it's developing multiple budget scenarios instead of single point projections. Start small, build momentum, create capabilities systematically. Remember, Every successful agricultural operation started with someone willing to invest the time and effort to master both the art and science of farming. You're already investing that effort by being here today. That commitment to continuous improvement distinguishes operations that thrive from those that merely survive. Thank you for your attention and your commitment to agricultural excellence. Now go build resilient, profitable operations that feed the world.